Good afternoon, everybody. I hope this is working. I appreciate all of you coming this afternoon. My name is Scott Hodge. I'm president of the Tax Foundation, and welcome to our 5th annual Tax Foundation University. This is a 6-week crash course in both economics and the economics of taxation. And in the past 4 years, over 200 of your colleagues here on Capitol Hill have come through this program. And I tell you what, this is probably the most important year that you could have a class like this and come to a program like this, because right now Congress and Washington are entertaining one of the biggest overhauls of the American tax system ever. And in particular, the blueprint as that's been put forward by Ways and Means Chairman Kevin Brady and Paul Ryan, the Speaker, is one of the most transformational tax reform plans ever seriously considered on Capitol Hill. You know, been a lot of tax plans over the last 60 years or so, but all of them have really tinkered with the income tax, or they've tried to perfect it in many respects. But the blueprint is something very different. It's a complete overhaul of the tax system in a very new way. But obviously, that's probably not what's going to come out as the final product, because obviously the House has to work with the Senate and the White House, and they have some different ideas. And from what we know, they're all working together to try to come up with a unified tax reform plan that they can push through both sides of Capitol Hill and onto the President for his signature. But you are truly living through a very exciting time in tax policy. I know for those of us in the tax world, this is about as good as it gets. It's like the World Series and the playoffs all at the same time. And this is the Super Bowl of tax policy, I guess you'd call it. But it's a very exciting time. But one of the challenges with this is that you're going to hear a lot of new stuff. A lot of economic jargon, tax jargon, concepts that are unfamiliar to a lot of us who aren't really steeped in these kinds of things. So this is an opportunity for you to kind of get up to speed, to sharpen your toolbox. How about that? I didn't realize that I had a theme song. Is there a vote? Oh yeah. Well, we got the one pager from the White House, so we know what their tax plan is about. As a friend of mine said, you know, I was looking for the details and I couldn't get past the first page. But this is a 6-week opportunity for all of you to sharpen your toolbox. To learn the kinds of things that you'll need to answer constituent questions, to answer your boss's questions, to talk to your friends and neighbors when they ask you questions about what the heck is going on with that tax reform plan. And I'm sure you're going to hear a lot of it over the summer and on into the fall. And this is a process that's going to be going on. As we've seen with previous tax reform plans, especially 1986, this is a long process. And there are going to be a lot of times where people are going to say, oh, it's dead. Or it's not going to happen. But this is sort of the cycle of things. And so those are the kind of things you're going to learn over the course of the 6 weeks. You're going to get some of those, how to speak tax, if you will. Learn some of the jargon, learn the economics, learn how to think about tax policy in the kind of ways that's going to be very helpful for you. And your teachers will be our Tax Foundation experts. Today it'll be Alan Cole, one of our economists, and senior fellow Steve Enton. Alan has modeled, he's one of our tax modelers, and has modeled many of the tax reform plans that have been put forward over the last 2 years, including a number of the tax reform plans put forward by members of Congress. And Steve is one of the architects of our dynamic macroeconomic tax model that we use to model and score these tax plans. You'll later hear from Kyle Pomerlew in other sessions, who heads our federal team. So you're learning really from the best, from people who probably know more about tax reform than anyone else in Washington, because we've scored more plans than anyone else in Washington. So without further ado, I want to thank you all very much for attending. I look forward to seeing you over the next 6 weeks, and I hope that you'll learn a lot. And don't don't hesitate to raise your hands to ask questions if you have them. So don't leave them till the end, but if something stumps you right away, if you've heard something that you don't quite understand, do feel free to interrupt and ask questions. This is supposed to be an interactive program and not just us lecturing at you. So please feel free to fully take part in it. And I'll turn over the program to Alan.
So, glad to be here. And what I'm going to talk to you about is the tax system as it currently is, because I think that's a good starting point to get into before we talk about how people might want to change it, or what they might want to do about it, or even problems with the tax code as it is. We'll just start with what you guys have so far. So in the current tax system, surprisingly, we've kind of collected the same amount of federal revenue as a share of GDP for a very long time. I don't think of this as an intrinsic property of our tax system, but rather it's just an artifact of the fact that we've generally had some politicians who want to increase tax revenues and use it to spend on things, and others who want to decrease tax revenues and return the money to the public. And they face off against each other. And overall, it's been pretty much an even fight over the last 70 years or so. Obviously, the New Deal and World War II really did make a large difference, and we've stayed at that level of spending since. However, when it comes to the composition of federal revenue, there have actually been a lot of underlying changes beneath the top line figure, where we've always kind of raised the same revenue as a share of GDP. In the early days of US taxation, excise taxes, various other fees, and corporate income taxes were a lot more important. But as the New Deal came online, individual income taxes were really needed. That was furthered by World War II. And also, the big change of the last 50 years or so is probably payroll taxes increasing steadily as we have an aging population. Payroll taxes fund things like Social Security and Medicare. So as the country gets older, as the ratio of younger people to older people gets smaller, those taxes need to take a larger share of people's income in order to fund those programs. And then the other little trend that we like to point out, because it has some important implications for business tax reform, is the declining share of corporate income taxes. That's not necessarily about businesses paying less of the burden than they used to. It's more that actually some businesses are taxed under the individual income tax. They're taxed in that blue bucket rather than the red. And the deal with that is that a lot of businesses, the majority, if you're counting each business equally regardless of its size, the majority of businesses actually file through the individual income tax codes on the individual income tax returns of their owner. So if you're looking at, say, a small Chinese restaurant or something like that, that's not a big publicly traded corporation. It doesn't pay entity level tax. Essentially, the owner of that would probably put all of his business revenues and business expenses on a schedule, turn that into a business income amount, and put that on their individual 1040. And that's the way a lot of businesses operate in the United States right now. They're often called small businesses. There's kind of an equivocation between small business and the businesses that file on individual owners' tax returns. There's some overlap, in fact, a lot of overlap between the two, but it's not always true. For example, Deloitte would be a very large partnership, but technically it's filed, all of its income is filed on different people's individual income tax returns, and there's no entity level tax for it. As an example of a C corporation that does pay entity level tax, does pay corporate income tax, think of something like Apple or Walmart. Pass-through businesses, when you adjust for the fact that they're generally smaller, even so, they're now the majority of business income in the United States. So all of those small businesses that file through the individual code, plus the few larger ones that do, they're actually a bigger part of the economy than the traditional C corporation. So this is kind of an interesting problem in tax reform. If you want to talk about business tax reform, often you have to talk about the individual income tax as well, because they're interconnected, because some of those businesses are filing on individual forms. But that's just a little aside on the history of how we've collected revenue, and one of the reasons that the corporate income tax is declining. What I'd like to go through now is how each of these taxes works, starting with the individual income tax. This is the one that's probably most familiar to you, but still it has a number of parts that we can go over. We're going to go over them in the same way that the 1040 does. There's a specific ordering to how each thing is calculated, and going through them in the same order that the 1040 does is useful and instructive. You start by essentially listing all of your income. Then you take away certain adjustments to income. These are often called above the line deductions because they come above the line where you calculate your adjusted gross income. And these are basically deductions or adjustments to income that everyone gets. Then once you have your adjusted gross income, then you get some additional deductions, typically either the standard deduction or itemized deductions, and the personal exemptions for, if you've got a certain number of people in your family, you can deduct a certain amount from your income for each one. And once you've done all of those deductions, you get your taxable income. That taxable income goes up against a schedule of progressive rates ranging all the way up to 39.6%. We've got 7 brackets right now. That's where the tax brackets come in. They apply to taxable income. And then finally, credits are a thing that come in at the end. And those are just a straight up, those are just a straight up subtraction from your tax bill. In other words, if you're paying $1,000 in tax, but then you get an $1,000 credit, then on net you owe 0. So credits are very valuable even in small amounts. They're more valuable than deductions because they reduce your tax rather than reducing your taxable income. And that is the general structure of the individual income tax. And we can look at each of these parts. Starting with, you list your types of income. That's the front half of the 1040, or most of it. You list wages and salaries. That's by far the biggest source of income. Then interest and dividends. Those are some of the biggest sources of capital income from investments and that kind of thing. You list alimony received. And later, if you've paid alimony to someone, that gets taken away from your taxable income. And then you see, starting at line 12, there's business income, and that's where we list the pass-through businesses that we talked about, those businesses that file on individual income tax returns. And IRA distributions, when you take money out of your IRA, that counts as income. When you put it in, it doesn't. And then there's some miscellaneous things, farm income, unemployment compensation, and so on. All of those get put together to become total income. This is distributionally different depending on how much you earn. Your sources of income are very likely to differ. We can see that for most people, wages and salaries are essentially the vast majority of their income. And the typical kinds of investment income that are outside of retirement accounts, those are much more a phenomenon for very wealthy taxpayers. And the reason for that is that less wealthy taxpayers usually store their savings in things that have better treatment than investment income. Retirement accounts over the long run will get you a better after-tax return. And so that's why you see retirement accounts being really a very big deal for people making less than $200,000 a year, but not so much for people making more than that. The reason it's not so much for people making more than that is that there are caps on how much you can put into a retirement account. Retirement accounts are great to the extent that you can contribute to them, but eventually they say you can't contribute anymore. For example, on a 401k, that's around $18,000 that you can contribute. And beyond that, they say it has to go in a regular brokerage account, and you have to pay capital gains and dividends taxes on it. After you've listed your income, there are a number of small above the line deductions. Few of these are very big. For example, most people aren't educators, therefore they don't take the educator expenses. Most people don't have eligible moving expenses. That's only if you moved a certain distance for work, and there's a whole bunch of other restrictions on it too. The majority of these are relatively small, politically popular usually, and that's why they kind of stick around. And a key feature of these deductions, as opposed to itemized deductions that we'll get into later, is everyone gets them. If you're taking the standard deduction, you're still eligible for these. The personal exemption is subtracted out of your adjusted gross income to get your taxable income, and that's essentially a reduction in your income per person. So if you have more kids, this is an important policy to you. If you have fewer kids, it's less important. And when people refer to claiming someone as a dependent, this is what they mean. It reduces your income by $4,050. And if you think of yourself as maybe being a middle-class person in the 25% tax bracket at the margin, this is worth about $1,000 to you. But a feature of anything that reduces taxable income is if you're in a higher tax bracket, it's worth a little more, and if you're in a lower tax bracket, it can be worth less. Because what matters is the rate against which that reduction in taxable income counts. As a side note, this is phased out for people once they make beyond a certain amount. It depends on what your filing status is. Some people are married, some people are filing singly, that kind of thing. But the phase out of the personal exemption is kind of like there's a little extra 1.1% tax that every dollar you earn, 1 cent goes to essentially the clawback of the personal exemption, and once you're beyond around the $400,000 range, you don't get it anymore. Then once you've calculated your personal exemption amount, then you move on to either taking the standard deduction or itemized deductions. Most people take the standard deduction, so we'll start with that one. It's also easier. The way that the standard deduction works is it's $6,000 for single filers, $12,000 for joint filers. If you have two people, then you kind of get a double-sized one. And then head of household, which is a status if you've got only one filer but a number of dependents, you get somewhere in between. And we're now up to about 69% of people taking this. But there's also the option of itemized deductions. There are basically three big itemized deductions that really matter, and then a handful of small things that don't matter as much. The three big ones are mortgage interest, state and local taxes paid, and charitable contributions. All three of those are extremely important. All three of those have huge revenue impacts. There are some miscellaneous things. There's kind of an attempt to help out people who have a lot of medical expenses on their taxes, but those are much smaller by comparison. Mortgage interest is capped to a certain degree. Once a home is valuable enough, you stop being able to deduct all of the mortgage interest on it. Then state and local taxes paid only refers to either income or sales taxes. You can do one or the other. The way sales taxes works is they sort of guess how much you paid in sales taxes. It's not an actual itemized amount of how much you paid. But that's popular in states like Texas. For state and local income taxes, you have to give them the exact number, and that's popular more in states like New York. And then charitable contributions, that's if you donate to charity, they'll give you a form that says you're allowed to deduct so much from your taxes. And that's a very big deduction as well. The one that's been on the table lately that people have been thinking about is the state and local tax deduction. And it looks like both the Brady plan in the House of Representatives as well as probably the President's plan are looking at getting rid of this deduction. And most presidential candidates actually talked about curbing it in one way or another, including everyone from like President Trump to Hillary Clinton to like Jeb Bush, Marco Rubio. Everyone took a bite out of this one in some way or another. And a feature of it is it's not particularly evenly distributed regionally. A large portion of its benefit goes to a handful of areas. And so the politics of that make it so that some members think they don't really get much out of it. So that's one to kind of look out for and see where the debate goes. The one reason you might want to have it is encourage state government rather than federal government. For every dollar the state government raises, the federal government loses some tax revenue. Reasons you might not want it are it doesn't benefit people near where you live, or it encourages state governments to get larger and you don't like that. So that's kind of a debate that I expect people to be having throughout the coming year. Once you've deducted your itemized deductions, then you've got your taxable income, and you start to apply them against the tax brackets. And one important thing that probably most of you know, but a common mistake people make is thinking if you move from, say, the 15% bracket to the 25% bracket, you suddenly owe 10% of your income more. That's not how it works. Instead, you go 10% from your first like $9,325 of income. And then for each dollar beyond the $9,325, you pay 15%. And then you do that up to $37,950 and so on. So it's kind of like there's no point at which earning a single dollar more totally changes your tax situation. The IRS is clever. They've thought of a better way of doing that. The married filing joint taxable income brackets are larger, and that reflects the fact that married people, there's two of them, so if you want to make the tax code progressive with respect to income per capita in a household, like obviously married people should mostly have brackets that are about twice as wide. It doesn't quite work that way, especially at the top. You can see at the start, for example, the 15% bracket, the married is double the single, but by the time you get to the 35 or 39, it's no longer like that. There's one special addendum to how rates are calculated. Capital gains and dividends get a lower rate than the rest of taxable income. And there are a few reasons for that. Well, one reason is it distorts the time value of money. Another would be that that income's already taxed at the entity level. Most nations tax capital gains and dividends at lower rates than ordinary income. We're not particularly unusual in that regard. Some have reduced it all the way down to 0. But usually a rate within the 20s is kind of the normal thing, where we're a little bit above the OECD weighted average. Tax credits are the last thing. They're a simple subtraction from your tax bill. So a $500 tax credit reduces your tax burden by $500. Some are refundable, some aren't. What refundable means is your tax burden can go negative. This happens for a lot of people these days on the income tax, and that's largely because of the earned income tax credit and the child tax credit. Both of these give you a credit for a certain amount of income earned, and it's also based on number of children. So they're kind of duplicative. They kind of both do the same thing, but that's where we are on them. The income tax is progressive. A lot of people have negative income tax burdens. And it's kind of got that shape because of the earned income tax credits applying strongest to people at 10K. The income tax is steeply progressive by itself. And the deal with that is income in the United States is got a pretty steep distribution, especially towards the top. And further, the progressivity of the code itself really makes this pretty strong. But when it comes to payroll taxes, they're kind of the opposite. They go up to a cap and then stop. And they're a combined base rate of 15.3%. So it actually looks a bit more like this when you combine everything. The last thing I want to get into is estate and gift taxes on the individual side. We have a pretty high rate, but also a very high exemption relative to the rest of the world. So extremely few people pay this, but when they do, they can kind of pay a lot. On net, this makes up like a very small portion of our revenue, a little less than 1%. It's about 20 billion or so per year, which is not very much in US tax revenue terms. But you know, it's a very big political flashpoint. People have strong opinions on it, even though it really doesn't affect most people at all. Corporate income tax is the last thing I want to go over. It's, or second last. It's basically revenue minus expenses. Expenses include employee compensation, and they include business inputs, but not dividends. So basically, the dividend owners are kind of the residual payers of the corporate tax, and that's where people think the majority of its distribution falls, at least on a static basis. But when it comes to who ultimately pays it, it's not clear, because obviously businesses can do a whole lot of things. They can raise prices, they can choose not to invest in things. And we think of the one exception to the revenue minus expenses thing is capital expenditures. If you lay out, say, $1 billion for a new plant to create automobiles or something like that, you don't actually get a $1 billion deduction immediately. Instead, you get it over about sometimes as much as 30 or 40 years. And that actually kind of distorts the time value of money a little bit, because if you imagine you started building something, you built it back in 1985, a dollar was worth a lot more, relatively speaking, then than it is now. because of inflation and because of the time value of money or borrowing. The exception to this is that small businesses get to deduct all of their stuff immediately, up to a certain qualification for small. That's called Section 179. A lot of people have proposed expanding that a little bit. Technically, the corporate income tax is progressive, but in practice, if you're large enough to be paying the corporate income tax as the optimal thing to do, if you're a large publicly traded corporation, you're going to be paying the 35% rate. And also there's an interesting question of, what is a firm anyway, and why would you be progressive with respect to them rather than progressive with respect to people? In practice, it's basically a flat tax. And then we have excise taxes and fees. These are pretty simple. There are just a bunch of small taxes on things, usually go to specific trust funds. Highway Trust Fund, Airport and Airways. A fun one is guns and archery equipment. Those pay for wildlife conservation efforts. It's kind of a hunting tax. A fun one is the phone tax, implemented in 1898 to pay for the Spanish-American War. And somehow that one just kind of stuck with us. We won the war a while ago. Maybe it's time for it to go, but it just kind of sticks around. Leaking underground storage tank tax is one of the strangest ones, and I don't think we actually have many leaking underground storage tanks anymore, so what usually happens is you hear about that as a random pay-for in a small bill. People just say, well, we'll take it out of the leaking underground storage tank fund. I was only on the Hill for a couple of months, and I saw at least like 3 or 4 bills that did that. And now, for the second half of today, I'd like to turn it over to Steve Enton and talk about reasons for reform and why we might want to change the system as it currently is.
Okay. Thank you, Alan. Well, we've seen the tax system. It's complicated, and it does things that perhaps aren't desirable. And this is one of the main reasons why we need some sort of tax reform. Reasons vary. The tax system distorts economic activity. It taxes some things more heavily than others. It discourages some growth activities and encourages some consumption activities. It tells you that certain inputs are going to be favored and other inputs are going to be disfavored. The net effect of the tax system, particularly its treatment of investment, depresses total income and employment. Well, how does depressing investment decrease employment? Well, you need a factory to work in, you need an office building to work in, you need machinery to work with. If we discourage the creation of that, we're going to discourage employment and wages. The tax system puts a lot of taxes on, well, leaking underground storage tanks and businesses, and individuals don't see the tax that they're paying. The money is embedded in the price of their products that they buy. So people don't see part of the cost of government. In a functioning democracy, you want the voter/taxpayer to know what's going on and to see if they think that what government is providing them is worth the price. The tax system is complex and expensive to comply with and hard to enforce. Estimates of compliance costs range from $200 to $400 billion annually. The business portion could easily be somewhere between 100 and 200 billion. Nobody's quite sure. But if it were, let's say, $150 billion, it would be worth 15 points on the corporate tax rate of 35. And you can see how that might play into international competitiveness concerns. It's, of course, subject to abuse, and there's always quarrels with the IRS, and nobody really likes to deal with the IRS. And of course, it is also viewed in many quarters as being unfair, although definitions of what you consider fair or unfair certainly vary. Another problem with the system that I think we really ought to focus on, we have had a dramatic reduction in the projected trend rate of growth in the economy. Since the financial crisis, CBO has more or less given up on giving us an economy that will eventually get back to trend. They've lowered their trend growth line, and they're showing us just about now getting back to full employment. But we don't seem to be catching up to where we were before And that means we have about a 17% gap in potential income. And you've all seen the figures in the most recent one included, the very sharp drop in the labor force participation rate. We have a very low unemployment rate now. We have a lot of people who aren't working because they've just dropped out of the labor force. It's a big cushion there, which if we could improve the treatment of workers and get wages up, they might come back into the workforce and help us grow faster. I don't usually like to talk about fundamental tax reform in the sense of a timing situation. A fundamental reform would improve the system forever. It would mean growth for a long period of time to catch up to where we should be, and then a higher level of output growing with population and technology over time thereafter. This is not a counter-cyclical concept. This isn't a, what do we do, we're in a recession, let's get out of it, kind of temporary thing. But we have an expansion now that's getting rather long in the tooth, and you could begin to see things slowing down. And this is just about the time when you might start worrying about that. So if you did have a fundamental reform that kicked up the growth rate, you could be killing two birds with one stone. But if you wait too long, one of those birds is going to be dead already, not in the good way. So we could see a full-blown tax reform potentially adding 9 or 10% to the long-run path of output, and then a bit more as you got that labor force participation up a bit, I think. And if we stall too long, the old, rather tired recovery could end in a heartbreak. And if we then went into another round of temporary pump priming and drove up the debt still further, you'd have less room for fundamental reform in the future. So I'd kind of urge you to try and get it done this year, or as near to it as possible. The tax code is over 10 million words long, and this is part of what leads to those compliance costs I mentioned. Moby Dick and Atlas Shrugged and War and Peace are very long, but they don't have bad effects on the economy. This one does, and we really ought to try to simplify it. We are one of the lower tax countries in the OECD, the Organization for Economic Cooperation and Development. The US is down there third from the bottom, but our tax system still is cumbersome, perhaps more than some of the others. Because we rely more on taxes on capital formation than they do. They do more on consumption taxes. We do more on taxes that hit saving and investment. The OECD at the bottom also has higher social insurance taxes because they have a much higher welfare state component. So we have lower taxes, but it seems to be almost as much of a drag as some of the other countries' tax systems because of its structure. In particular, we're the highest tax rate in the developed world. We used to be under France, but they got smart and came in under us, not by much. But it is certainly something that's interfering with competitiveness. This is one of the reasons you hear some talk now about maybe we should rush ahead and do corporate reform and not do the individual reform, because it's such a serious problem now with our competitive posture. And more concern every year as our trade deficit continues and foreign holdings of US debt keep getting higher. But as Alan pointed out, it's very hard to do the corporate side alone because so many business provisions, such as depreciation and the treatment of interest and all the rest, apply to the non-corporate sector as well as the corporate sector. They're rather intertwined. We used to have one of the lower corporate tax rates in the world back in the 1960s and 70s, but we've kept our rate fairly high, and even after the reduction in 1986. And the rest of the world has repeatedly reduced its corporate tax rates because they've been forced to become more competitive. When you had the European Union formed, of course, you had a lot of the European countries lowering their tax rates, and around the world people realized that the corporate rate was a problem for growth. So we have a number of problems with the corporate rate. Our high rate discourages capital formation in the United States. That would be true if we were the only country in the world. But it gets worse because we aren't. The taxes on capital, by the way, are largely shifted to labor. When capital shrinks because of the tax, there is less machinery for workers to work with. The marginal product of labor goes down, and the wage goes down with it. It used to be thought that the taxes on the corporation were borne by shareholders, but by the 1950s and early 60s, people were thinking that it forced capital out into the non-corporate sector and reduced their rates of return. And Arnold Harberger, a prominent University of Chicago economist, pointed out that capital could go abroad. And if it went abroad, U.S. workers would suffer and foreign workers would gain. And then it became apparent more recently that taxes on saving and investment depress the saving rate. So there's less total capital in the world, including here. So again, the workers are hit by the reduction in their work opportunities. The rate also encourages shifting reported profits abroad to lower tax jurisdictions. The Europeans are responding to this with what they call the BEPS initiative, the Base Erosion and Profit Shifting Initiative, which involves enormous amounts of additional reporting by businesses, subsidiary by subsidiary, country by country, so that all the countries can see whether they're paying enough in their country. And surprisingly, I think, well, not surprisingly, I think, you're beginning to see situations, as we see here in the States, where one state thinks that a corporation is having a lot of work in its state. They have an apportionment. Your total income, well, how much is in our state? Well, we can do it by looking at your employment or your sales or your assets, your plant and equipment. And states pick whichever measure they think gives them the best share of the company's income. By the time all the 50 states are done, they may end up taxing 150% of the company's income. Well, I think you're going to see this on an international basis if this concern about profit shifting isn't addressed. And so I warn you that BEPS really stands for beware bureaucrats poaching shekels, because they seem to go after U.S. corporations more and more, and that's something to be aware of. Which gets us into the question of global versus territorial taxation. About 6 countries, most of them tiny, one big in area, Brazil, I think, but not so much in terms of economic power, tax on a global basis. If you're a multinational corporation in the United States, you're going to owe tax on your worldwide income, and then we give you a tax credit, a foreign tax credit, if you paid tax to a foreign jurisdiction on a portion of that income. If our rate is higher than theirs, you owe us the difference. Most countries don't do that. Germany taxes plants in Germany, but if you're a German company with a plant in France and the French have taxed it, the Germans say, that's not here, we don't tax it. And the French do the same for the Germans. But with us, we have all these tax treaties, and we start the global tax business, and we have the problem of dealing with having to pay perhaps a higher tax than our competitors abroad. Now, this tax isn't collected immediately, it is deferred. That's called deferral. And there have been many attempts in the Senate over the last 40 years to get rid of it. It almost passed by one vote, I think, in 1976, but was not. And we have the deferral, which does allow our companies to continue to compete abroad, but it discourages them bringing their money home. Now, you hear a lot about that, and I think Kyle will go over that in a later lecture. But a lot of that money is already home. It's parked in the bank accounts that our foreign subsidiaries have in New York banks and is lent to Americans and other people around the world by the banks. The issue of bringing it home is not that it's not able to help finance investment in the United States. A U.S. subsidiary can borrow against its parent's bank account. But that's a nuisance. It's complex, there's interest charges, and it's not a free allocation of your balance sheet and your portfolio where it should be. It's a nuisance. But there is this revenue potential by having a deemed distribution of that past foreign earnings that hasn't come home yet to help pay for tax reform. And that's what you're seeing in several of the plans that you might be looking at. Again, most other countries are on a territorial basis. It's extraordinarily more simple than the current system, and we ought to think about how we could do that. There are many different methods, which we'll get to in later weeks. In designing tax reform, you have a few things you need to be sure you do, and this harks back to the way you collect taxes that Alan talked about earlier. You have to choose the type of tax. Are you after an income tax? Are you after a business level tax? Should it be an individual level tax? Should it be on what we call total income or broad-based income, which is not only your initial earnings, but your savings and the earnings on the savings? Or should it be more on consumption, where saving is tax deferred until you spend it? We have to have some goals in mind. We have a revenue goal. We want to know what's going to happen to economic growth if we change the tax system, and if growth is an objective, or wage growth in particular may be an objective, you might need certain features in the tax system. Then there are the distributional tables and your distribution goals. Now, if you're going to explore those issues and know what the bill you're looking at is going to do in that regard, and if you're going to design a bill to meet certain targets, you have to know what these provisions are going to do in all these areas. And for that, you need to study them a bit. You have to estimate the outcomes. And we have the static scoring that is assuming no change in GDP, which is often used for budget work. But then we have the dynamic analysis and scoring to tell you, well, will this create jobs or won't it? This provision, how many jobs will this provision produce? If this alternative provision were substituted, how many more or less jobs would be created? And what would the effect be on the budget if it did or did not add to growth? All of these things are necessary if you're going to come up with a bill that meets your preferences and your goals. And this is important when you get to the situation in the Senate in particular, where you have to navigate the budget process. You have the Byrd rules, which say you cannot, for example, raise the deficit beyond the budget window. Now, that means that provisions that may not cost very much up front, but cost more later, might prove to be out of order. Even though it's a satisfactory outcome in the budget window, you're willing to spend that much. If it gets to be anything that spills over beyond the budget window, the Senate might rule it out of order, in which case you then need to come up with revenue offsets or sunset the provision. And if you sunset the provision, you create uncertainty. People aren't going to expand a factory if they know that in a few years they can't sell the product because the tax went up. So we have to navigate the budget process, and then of course you have to explain the whole thing to the public, which means that you and or your bosses are going to have to get used to explaining some very complicated provisions, some very complicated Senate and House budget rules to people if we're going to get through this. So this is not a quick process necessarily. As Scott pointed out, it can be rather time-consuming. I would just suggest that keep the goals in mind. More jobs, more growth, and it's going to be good for everyone. We have tax expenditures. I'm going to go over them briefly. We might go over them later in the course. By the way, in the 2000 aughts, OMB expanded the discussion of tax expenditures in the federal budget in the special analysis section. Instead of just doing what are the tax expenditures in the context of the normal income tax, it pointed out that tax expenditures are tax expenditures only against something you consider normal. So it went back and said, well, what if it were a pure income tax that we wanted with no exceptions? Because we have exceptions now, like pensions, which are a special treatment of saving. Suppose you consider, all right, if there are no exceptions, what are the tax expenditures? What are deviations from a pure, unadulterated income tax? What about the tax system we're used to, the sort of normal current tax system? What are the tax expenditures there? That's a different list. In the normal income tax system, you wouldn't perhaps expect the personal exemption to be considered a tax expenditure. In a pure income tax, you wouldn't have any income excluded. In the personal exemption, we consider that normal, and we would not count that as a tax expenditure in the current system. In a consumption tax system, you get a whole different mix of things. Whereas pensions are considered tax expenditures under the income tax, and the consumption tax, they're all considered normal, because you don't tax anything until you go to the cash register and spend your money. So, in fact, because pensions are generally capped, it would be called a negative tax expenditure because we don't give the treatment to all saving only some of it. So you get all these different lists. And even within the current tax system, you have different lists out of the Joint Tax Committee and the Treasury. Well, LIFO is in one, LIFO is not in the other. So you have to take a look at tax expenditures carefully. Another problem with the tax expenditures is that they're estimated on the basis of what if the provision had never occurred, and we are fully adapted to the alternative tax system. That number is not what would happen if you suddenly repealed one and there were a transition. So it won't give you a budget revenue estimate in all cases. And joint tax also has the right and the practice of saying, well, if this tax expenditure is closed, people might switch over and use this one. So you won't get the same revenue score just by looking at the numbers. So you can't just go to the tax expenditure table and say, let's get this and this and this, put them together, and that gives us our money for the bill. In addition, there are interactions between them. If you have further accelerated depreciation, then changes in corporate tax rates don't cost as much and vice versa. You have all these interactive effects with these things. Now, most of the tax expenditures go to individuals. In 1986, we closed a lot of the so-called loopholes in the corporate sector. And there's not much there anymore, which gives you another issue when you go to business tax reform. But they're mostly in the individual sector, and the biggest one is the exclusion of health care insurance provided by the employer. It's a big one, I think about $500 billion, something like that. It's a huge number of income that's simply not taxed. And you can see, and you know from your constituents, that would be a very difficult one to give up on. The individual tax expenditures are chiefly about saving, health, and housing, and you can review that at your leisure. I won't keep you with the details, but there are literally hundreds of them in the Treasury and OMB tables. Now, the budget rules, you're all familiar with these words, but you may have not actually had to sit through a time on the Senate floor when people were arguing about them. I came to Washington in 1975, the year after the Budget Act, and in 1976 we had 2,000 amendments in 3 weeks from 8 in the morning until 11 at night. And at one point somebody wanted to waive the Budget Act. And Ed Muskie, who was chairman of the Budget Committee, was literally in tears saying, "You mustn't do that, it's going to kill it at birth." And well, we still have the Budget Committee and we still have the Budget Act, but it's still moving people to tears. And the key point is, sometimes when you really need to do something because it's good for the country, you get so tangled up in your own procedures you can't get anywhere. When the dust settles, I really would urge you to try and do something about that. So you have the concept of reconciliation, where you can get something done under a budget resolution with a 51-vote margin, but if you do, you get stopped by some of the Byrd rules, which say you can't go beyond the budget window if it's going to lose revenue beyond that. So you get sunsetting, or you find alternative revenues beyond the budget window. And it's kind of hard to cross the dividing line and say, well, we're going to cut spending over here past the 10-year window to help fund the tax cut. They tend not to do that. And then the issue that's come up recently is, why don't you just redefine the window? If you've got a tax change that costs something in years 1 through 15, but is raising money in years 16 through 154, why not just extend the budget window to 15 years and your problem is solved? That might be considered a kind of a gimmick, and yet these artificial windows are indeed artificial, so you can think about what you might want to do there. Knowing the growth and budget outcomes of various tax revisions really does have to be carried beyond the budget window now, because in particular of the Senate rules. And when we get to the blueprint analysis, you'll find that some of the provisions in that proposal, although they run deficits in the short run, they run rising surpluses in the out years, partly to get around the budget rule, the Byrd rule, and to cover the ongoing revenue losses of other pieces of the bill. They did put something together that they thought would pass muster in the Senate if it went over in more or less one piece. The House, by the way, has been working on tax reform, major tax reform, for about 5 years. They've been bringing members of the committee in working groups. They've had briefing sessions. They've had repeated meetings. They've gone down some roads that didn't pan out. They've backed up and gone down other roads. I've never seen that kind of activity in a major committee in the Congress before. They really have been doing their homework. The Senate is not as far along by any means, and if you want something done this year, it's kind of hard to see what can happen over there to get a major consensus built without the constant briefings and work that has been done over on the House side all these years. This is not something you can just whip together in a few weeks. Well, there are really 3 main things to be balancing in tax reform. You've got the need for revenue, you've got the considerations of equity, and you've got the need to do something about economic growth and getting wages and employment up. Now, it's sort of like a scale with 3 balances instead of 2, and the sad news is you can't do all of them at the same time necessarily. Particularly if you're looking only at the distribution tables that don't take growth into account. You're going to see things that look like they're adverse on the distribution, even though they may add to growth and raise the wage later. So if you look at only one time period, you're going to get a different answer than if you look over time. So it's quite a juggling act, and you need to be dealing with it. One of the things we've known from both economic theory and history is that different types of tax changes have sharply different effects on the economy. And one of the things we've been modeling and collecting the data on for almost 20 years now is how various things do impact growth. Way over on the left, we have an increase in the child credit. This doesn't change how many hours you want to work or what the after-tax wage is per hour, so it doesn't really affect employment or hiring, and so the static and dynamic revenue estimates are really pretty close, and it loses money. Lowering the income tax rates gets you some response with higher wages and higher small business activity. So you get some growth out of it, and so your static and dynamic revenue estimates aren't quite the same. When you get to the corporate rate cut, it loses a ton of money on a static basis. It almost breaks even on a dynamic basis, and it does produce more GDP growth than some of the individual rate cuts. And then the distortion of the write-off periods for plant and equipment, which does so much to discourage new investment in plant and equipment, seems to have a very powerful impact. And these are all tax changes of roughly equal static initial revenue loss, but they have very different outcomes. I'm not going to try and get too much into the details of why these things happen in these particular taxes. I just want to point out to you that if you don't know these differences as you were putting the bill together, you won't know which of the trays on that three-tray scale are going to go up or going to go down, and by how much. And you don't know what's going to show up in the revenues, which you do need to fund the government going forward. So you really have to know what is going to happen to you and your budget and your constituents in order to put a good bill together, and that's why this analysis needs to be done in detail. I'll just show you a short run and long run on a couple of these. Expensing costs money initially while you're writing off the new investment right away, and some of the old investment is still being depreciated from the past. But when you get toward the future, you find that the write-offs are much smaller because you're not writing off two things at once, and the growth kicks in, and even when you take out some of the added borrowing, you're going to come up ahead, but you're going to come out ahead toward the end of the budget window and more beyond it. So if you're worrying about the bird rule, you have to go beyond the 10-year window, and you have to ask Joint Tax and CBO to extend their 10-year framework of analysis to out years in order to know whether or not this is going to pass muster under the bird rule. And CBO and Joint Tax can do this and do this, at least internally. They don't generally publish. And then you have to worry about the debt eventually, and is it rising or falling? With this particular provision, it rises for a period, but the growth kicks in, and the GDP starts growing faster than the debt, and so the ratio drops. And then the corporate return looks a little different. It's not quite as powerful and doesn't quite get into surplus after borrowing costs in the future, but it's less damaging than it might appear on a static basis. And the debt goes up, then comes down, then goes up again as a share of GDP a bit. But all these things are important to know when you're designing the bill. I'm not going into detail on these here now, but you have to do this kind of analysis if you're going to achieve your objectives about revenues, fairness, and growth. And if you don't do the analysis, you're going to have surprises down the road in the budget, and then you may find that Congress is backtracking on the reforms, in which case they're not permanent, in which case businesses really can't plan ahead, and it sort of messes up the entire process. So in the weeks ahead, we'll go into the economics of taxation a bit, why these things have different results, and I'm hoping by the end of the period we will have some software in place where you can actually get your hands dirty and take a look at some of the provisions in some of the major plans, such as the blueprints, and saying, well, if I drop this and substitute that, what's going to happen to revenues, what's going to happen to growth, and what's going to happen to the budget down the road? Because we have a bill under consideration which has some major revenue offsets as well as major cuts with winners and losers. And I know you're going to hear from all of the losers even before you hear from all of the winners. And you have to explain to your constituents that there might be more winners than losers here. Let's go ahead. But let's see if we can get you into a situation where you can convince yourself at least that there are some issues here that need to be addressed, and that's why some of these things are being said. So that should give you a helping hand in dealing with the issues that are coming out over the next several months. I'm delighted you're here, and I'm hoping this series of presentations will really prime you and eventually your members for some very hard work this summer and fall. Thank you for coming.